Imagine a place with beautiful beaches, relaxed regulations, and extremely low taxes. This place isn't just a vacation destination, it's a tax haven. Tax havens are countries or jurisdictions that offer minimal or zero tax liability on income earned elsewhere. They attract businesses and individuals seeking to minimize their tax burdens. The Organization for Economic Cooperation and Development, or OECD, identifies 4 key factors that define a tax haven: low or no taxes, lack of transparency in financial transactions, lack of effective exchange of information with other countries, and no substantial economic activity beyond providing financial services. However, the line between legitimate tax planning and harmful tax avoidance can be blurry. The use of tax havens raises significant ethical and economic concerns, especially when they facilitate tax evasion and illicit financial flows. Tax havens operate by creating a legal framework that allows foreign individuals and companies to shelter their income and assets from taxation in their home countries. They often have strict secrecy laws that protect the identity of account holders, making it difficult for authorities to track financial flows. One common method used is establishing shell companies. These are companies that exist only on paper without any real business operations. Their sole purpose is to hold assets or conduct transactions on behalf of their beneficial owners, who remain hidden behind layers of corporate secrecy. Another method involves using trusts, which are legal arrangements where a trustee holds assets for the benefit of beneficiaries. Tax havens often have favorable trust laws that allow individuals to shield their assets from creditors or tax authorities in their home countries. The primary attraction of tax havens is obvious: lower taxes. Businesses can significantly reduce their tax liabilities by routing profits through subsidiaries in tax havens. This allows them to keep a larger portion of their earnings and potentially reinvest in growth. Individuals, particularly high net worth individuals, may use tax havens to protect their assets from creditors, reduce inheritance taxes, or simply minimize their overall tax burden. The promise of financial privacy is another key driver, as tax havens offer a high degree of anonymity and confidentiality. However, it's crucial to remember that not all use of tax havens is illegal or unethical. Some businesses may have legitimate reasons for using offshore structures, such as facilitating international trade or managing currency risk. The dark side of paradise: negative impacts of tax havens. While tax havens offer potential benefits, their negative impacts on the global economy are undeniable. By siphoning off tax revenues from other countries, they deprive governments of resources needed for essential public services such as healthcare, education, and infrastructure. The International Monetary Fund estimates that governments lose hundreds of billions of dollars annually due to corporate tax avoidance facilitated by tax havens. This lost revenue can exacerbate budget deficits, leading to cuts in public spending or increased borrowing. Moreover, the secrecy provided by tax havens creates opportunities for illicit financial flows, including money laundering, tax evasion, and corruption. This undermines the rule of law, distorts markets, and fuels criminal activity. Beyond legality, unveiling the misuse of tax havens. While some uses of tax havens may be legal, their misuse for illegal activities is a serious concern. One common method is trade misinvoicing, where companies manipulate the prices of goods and services in their invoices to shift profits to tax havens and reduce their tax liabilities. Another method is round-tripping, where money is sent to a tax haven and then returned to the country of origin disguised as foreign investment. This allows individuals and companies to evade taxes and launder money, often with the help of complicit banks and financial institutions. The Panama Papers and Paradise Papers leaks exposed the vast scale of offshore tax avoidance and evasion, implicating politicians, celebrities, and multinational corporations in complex schemes designed to hide their wealth and avoid paying their fair share of taxes. Charting a course, addressing the challenges of tax havens, combating the misuse of tax havens requires a multifaceted approach involving international cooperation, increased transparency, and stronger regulations. The OECD's Base Erosion and Profit Shifting Initiative aims to curb tax avoidance strategies used by multinational corporations, including the use of tax havens. Greater exchange of information between countries is crucial to track financial flows and identify tax evaders. This includes requiring multinational corporations to disclose their profits and taxes paid in each country where they operate, a practice known as country-by-country reporting. Ultimately, addressing the challenges posed by tax havens requires a global effort to promote tax fairness, transparency, and accountability. This will require political will, public pressure, and a commitment to creating a more just and equitable global financial system.